Hey, hi everyone. Welcome to another video in our hedge fund strategy series. So today we are going to discuss about long short strategy. So this is another hedge fund strategy. We already discussed about global macro strategy as well as contra trading strategy and quant trading strategies, and we have also discussed event driven strategies. So this is another strategy used by hedge funds, which is long short strategies. And what it basically means is going long or a short on an equity. So long short equity is a prevalent hedge fund strategy. Basically takes long positions in undervalued stocks, expecting for them to appreciate, and short positions in overvalued stocks, anticipating them to decline. So basically going long in a company which has a potential to grow, and the stock price has a potential to appreciate, and shorting some stocks which are overvalued, and their stock price will decline. So that is basically the strategy. And you can go in a single long. So basically you can only go equity long, so you can only take long position in certain equities where you feel like these companies are going to perform well in the future. And you can short certain stocks also if you feel like this industry is gonna not going to perform well, and or these stocks in this industry are not going to perform well, or specific stock is not going to perform well, so you can short that particular thing also. So this is what is in the strategy. And this basically aims to capitalize on stock specific opportunities, and mitigating the market risks. So that is what this strategy is. And the hedge funds that use these long short strategies, or Rob Citron is the hedge fund manager of Discovery Capital Management. He has achieved 50% annual returns over the past 2 years. And the most notable trade which he has done is shorting the regional banks during the 2023 banking crisis. So this is a shorting, basically shorting that banks, and basically profiting from when the trade goes right in your direction, you're profiting from that particular trade. And he also made successful investments in Latin American markets, Argentina, following market friendly reform. So this is like uh, investing, assuming that the country will grow. And yeah, so basically he will invest when it is undervalued, and when the price appreciates, when the particular markets perform, Argentina market. Maybe he took a distressed debt and restructured it, or invested in that company that it would take a turnaround, and it was successful following market friendly reforms. So they made a good amount of money in that particular trade. Strategy, what it does is this long short strategy, it basically combines macroeconomic analysis with asset specific insights. So investing in Latin American markets, especially Argentina, assuming that they'll do some friendly reforms, and it will go up, is a macroeconomic analysis. And yeah, profiting from shorting regional banks is more like asset specific insights. The other hedge fund that uses this short strategy is Bill Ackman's Pershing Square Capital Management. So Bill Ackman has initiated a significant investment in Amazon, anticipating robust earnings despite tariff concerns. So even though there are tariff concerns, he has basically made a significant investment in Amazon, and he anticipates that there will be a robust earnings. So this is like a long going long on a particular stock when its price is undervalued, okay, or expecting it to grow, the company to grow, and along with your stock price to grow. So that is the strategy. And exited a profitable position in Canadian Pacific to reallocate resources. So he already has invested in Canadian Pacific, and made a good profit, and he exited that position. So when you feel like you made enough money, and the growth potential or the shorting of the stock, whatever move you have anticipated, it's done. You have to basically exit that position and book profits, and then so that you can reallocate those resources and new opportunities, right? He also added positions in Hertz and Uber. Hertz is a company which basically rents cars, and Uber is a ride sharing company. So, and adjusted holdings in Chipotle, Hilton, and Universal Music Group. So this is basically going long on all these companies, and it is basically value investing. Active His approach is active management with a focus on long term value creation. So this is long. Okay. Larry Robbins from Glenview Capital Management also deploys this strategy. He employs a long short equity approach, focusing on companies with predictable earnings and strong market positions. Okay, in 2013, Glenview Opportunity Fund achieved 84% gain, leading Bloomberg's markets rankings of the best performing large hedge funds. So the notable trades in this long short strategy are Rob Citron. He capitalized on the 2023 banking crisis by shorting regional banks, and that move basically contributed to significant improved and impressive returns for the fund. Bill Ackman identified a buying opportunity in Amazon during a stock price dip caused by tariff concerns, reflecting his contrarian investment approach. Milestones achieved or Discovery Capital Management got consistent high returns using this strategy, approximately 50% annual gains over 2 consecutive years, showcasing effective strategy execution. Glenview Capital Management is recognized for outstanding fund performance, with opportunity fund leading industry rankings. So this strategy, has helped these funds to achieve consistent and above average returns. Challenges in this strategy are market volatility. So long short is basically when you are investing, you're basically having this risk, market volatility risks. If there is a rapid market shift or some black swan event, then yeah, that is a risk for your position. But if normal things go and everything is as usual, you will make good money. Even when markets go against you, if it is a temporary thing, then you can buy again, at that dip, and make a lot of money. Like during housing crisis, Citadel has brought some assets, and it made a lot of money. Um, but yeah, but that risk is there, market volatility risk is there. And short selling risks are there. When you short a position, you carry the risk of unlimited losses. So if the stock price rises significantly, you need to basically monitor the risk, and actively monitor the risk for the stocks that you have short sold. Regulatory scrutiny is there. Short selling is highly regulated, and it is scrutinized by government agencies, and so that impacts your strategy execution. This long short strategy basically aims to exploit the pricing inefficiencies by balancing long and short positions, and it tries to deliver positive returns regardless of market direction. Industry trends: the long short equity has seen a resurgence newly again, with hedge funds specializing in this approach and posting the best returns since 2020. Again, in this long shot also, there are various ways, like going only long, going only short. And there's another strategy, like market neutral, or benefiting from doing both long and short at the same time, which is called as market neutral position. So let's discuss about that market neutral position. So what these are, it is called a statistical arbitrage also. So what that the particular strategy is. So let's go into deep. Okay. So first, let me tell you the what these companies do is, when they do statistical arbitrage, they find or or deploy this long short strategy. What they do is they find some assets, okay, two pair assets, or two pair of assets, or a pair of assets basically, which have a high correlation. The correlation is basically, if one moves, the other moves. Basically, if the correlation is one, means basically they're highly correlated. For example, gold and silver, if you take the correlation of these two commodities, the correlation coefficient of these two commodities is 0.92, which basically means, like, if gold goes up, silver will go up, and if gold goes down, silver will go down. So they'll pick some commodities, or some stocks like this, like for suppose Pepsi and Coke, or anything which has a correlation. So some securities will have correlation, and if it is around 1 or 0.92 or 0.95, you basically pick those two particular commodities. Then what you do is, yeah, let me open this. I need the chart of the gold and the silver to explain you clearly how statistical arbitrage works. So we look at two assets which are highly correlated with a correlation coefficient of near 1 or 0.95 to 1. Okay. And in this example, I'm specifically taking example of gold and silver, but you can take any commodities or any securities which have a correlation. Okay. Uh, yeah, let's wait for some time. This is taking some time to load. Yeah, long shot also works in a few other ways. Like you can also take certain positions, like in the long short world, if you feel like example of both taking a long and short position are, if you feel like Ford company will go up, whereas Daimler Chrysler will go down, then what you do is you take a long position in a Ford and you take a short position in Chrysler. So what will that do is, if your view is correct, basically you're going to make money. If Ford is going to go up, you're going to make a money, right? Because that is your view. And yeah, that is one way of doing this, deploying this long short strategy. So hi everyone. So this is the gold chart. Yeah, so this is the gold and the silver chart. And if you see, this is over a lot of years basically. So what we have discussed is the correlation should be near to 1. And then what you do is, so for suppose you deploy this long short strategy, right? So anywhere you can deploy this particular strategy. Like if you take a position here, you short gold here, and you basically take a long position on, either you can do both ways, or you can, if you feel like gold is going to go up, then what you do is you take a long position in gold here, and then you short this silver. Okay. And what will happen in this case is, basically the gold is going to go up a lot, right? So gold is going to go up a lot compared to um, silver, right? So what we are doing at this stage is, these two assets are highly correlated and their prices should be near equal. And gold and silver is one example, but you can take some companies also like Pepsi and Coke or some other companies, where you will see the discrepancy in the prices, and you assume that those prices will converge to a particular point, right? And you take a bet on a particular security which is overpriced, you short it, and a particular security which is underpriced, you basically take a long position on that particular thing, and you will make money. So for example here, if you have taken a position that gold, you take a long position on gold because you feel like gold is going to go up, and then you take a short position in silver, then what will happen is the money you'll make when gold goes a lot, and even though your short position is going to give you loss, but this will give you a lot of profit, and that spread is what you'll make a lot of money on. And here, when you feel like gold price is too high, now you short it here, and you can do shorting of both also, but we are talking of long short strategies. But if you short this one here, and you basically go long on this one here, then what will happen is you will make a lot of money, because gold is going to go down a lot, and silver is going to go down only to a certain extent. Okay. And you can take some positions the other way also, like for this example here. So you feel like here the same, like silver and gold, you basically again, you can go long on silver and short the gold, or you can go long on gold and you can short the silver, both you can do. And yeah, so this converging to mean, okay, and the spread difference, okay, is what is going to make you a lot of money. Okay. So that's basically the strategy. Like in this position, you feel like this is too away from the normal price. Okay, then what you do is you short the gold here and you take a long position here, then you'll the short position will give you a lot of profit. The long position will not give you a lot of loss. Okay, so and then you make a lot of money in this trade. Okay. And similarly here, you can just if you feel again gold price is too low here, you take the position long position here, and then you can take a long position in silver or you can short silver. Then the discrepancy or the spread between them will give you a lot of money. Okay, and you can take a long position in silver here and you can short gold here because the price is, a lot of variance is there. And once it goes up like this and once it goes down like this, you'll make money basically. Okay, so that's the strategy, the long short strategy. I wanted to discuss that as a part of today's class. In long short also there are multiple variants. Long you can go and you can go short, you can go hedge long also, long short also you can do. Like you can go long, like if you are 100% putting money, you put like 70% on long and 30% on short also you could do. Or you could do, long and short arbitrage difference also you can take to trade. A market neutrality trade also you can do. Okay, so these are the various strategies deployed in long short strategies, and these are used by hedge funds. And I just wanted to cover that today. So thanks everyone for joining the call. Have a nice day.